All right, good morning. It is 7:30 and time for our review of the markets. I'm going to skip the PowerPoint this morning because we've got enough to talk about on the charts and some other things I want to show you. We're going to go through seasonality and we're going to go through commitment of traders today. So we'll start with Kansas City wheat because it's probably the easiest and quickest to get through. So we've got this consolidation area that's happened here over the last week or so, and as we consolidate, we're finding support. Now, if we go all the way back through November, this is the same level that found support all the way back in here. So if you look, we've traded almost all of our trade action has been above this 440 level going all the way back to November. So the odds that this gets broken are not that great, particularly if you look at the macro environment. You've got dryness in Europe. You've got weather issues over there, and we don't know what the yield is going to be. You've got issues in western Kansas. You've got good yields in the center of the state. So there's enough there to keep the market supported, and there seems to be seems that bad news probably got priced in on wheat. So wheat shouldn't have a lot more to the downside for funds to really press the short side. And certainly this action right in here, where we keep getting hook reversals back to the upside, is leaning back to the bullish side. So we had this big consolidation area, and wheat really looked like here it was poised to make a significant rally, all the way up into this 530, 540 range. Clearly, the market did not agree, so it broke down. This is telling us that we should come challenge the bottom of this cloud. So at 470, we really want to pay attention because move back up through the cloud will really should ignite a more significant move and move us back higher. So if you're looking at it just from a straight risk reward perspective, right, you've got maybe 10, maybe 20 cents of risk for 75, 80 cents or $1 of upside potential. So I think traders are going to really take a look at wheat and think, well, why do we want to press the short side? And so if you watched the trade yesterday, when corn would tick up, wheat would tick down, and vice versa. When corn ticked down, wheat came up. So they were selling wheat, buying corn, and vice versa all day long yesterday. So if that trend continues, and corn starts to rally, I guess that could put pressure on wheat. But really, that's about the only thing. So, so I'd be very, very patient with wheat, and I'm not going to dwell on it any longer. I'm bullish above 440, and we're just going to stick with that. If we trade below 440, we'll reevaluate, and we'll definitely scratch our heads if we break 427 and really start to work lower. If that happens, something has materialized that's really changed the landscape and grown our carryout. So above 440, the bias should be up. All right, let's look at soybeans. Soybeans are in an interesting spot and have been for quite a while. Lots of talk about China. You read the news, and China's all over it. We've got military buildups. You've got skirmishes on the China-India border. You've got uncertainty in North Korea. You've got military buildups from our side in the South China Sea and in Japan. You've got China putting out rhetoric about preparing their military for combat, and we've got the trade war going on. So there's a lot of posturing going on, and I don't think anybody knows the real story or what's really happening. But in my view, in reading all of the stuff that's out there, is that these governments are doing something at a very, very high level, and we're not privy to any of the real information. And so we just have to trust our leadership that they're doing what's in our best interest, and ultimately that will prevail. And and all of the news and all of the headlines, in my view, should really be looked through. When we look at supply and demand fundamentals, are soybeans being sold? The answer is yes. We're moving product. So even amongst the rhetoric, we are selling product to international buyers. Demand numbers here are solid. Now on the flip side, the weather looks pretty good, right? We've got the crop in the ground, it's emerging, there's very little threat out to it at the moment, so the yield should be there. So the market's digesting all these things that nobody really understands or has the information to understand, and it's digesting yield and it's digesting sales. So what does that look like on a chart? Well, it looks like this. We've got this big green area here that I highlighted, and this has been the upper range and lower range for the last month and a half. Now, this range will break out one way or the other. If we can trade up to the upper end of it and get inside this cloud, it leans bullish. And it really leans bullish above this 835 level, all the way down to the bottom side of it, particularly when you look at what the carryout is. Remember, last week we went through the stocks to use ratios, right? We said we're at the USDA is projecting a 9% stocks to use. But if we have a yield hiccup, then that can drop under 5 really quickly because soybeans are very sensitive to yield. Now, if China doesn't buy or we get into some sort of a conflict, maybe that will be perceived as bearish. But assuming that things hold the course, it looks like soybean sales are going to be there, and the carryout looks like it has more risk to contract than it has to expand at the present moment. So, so we're bullish beans above this 835 level, and particularly going into the summer growing months as we get some weather risk. I want to show you the weather map before we jump to anything else. This is your 8 to 14 day NOAA heat map, right? So you've got this big center spot, which implies very hot temperatures. Now, if this forecast was in the middle of July, this is really bullish. On May 27th, I don't think it's that bullish. In fact, it may even be slightly bearish, because it's good for the crop to get a little bit of heat, dry down a little bit, and maybe get some of the stuff that hadn't been planted. If this persists, though, then that could turn into some sort of a catalyst that could really get us moving. All right, so beans. Very simply, we are waiting for it to break out of this rectangle. We're going to see if it breaks up out of its clouds and into them, and maybe we can get a rally. And if it does start to rally and breaks up out of here, our target is 908. That's where we should get into real support. Below there, we've got resistance at 860. We've got resistance at 878. We've got resistance at $9, and then 908 to me is the real line. So if we can crawl above 908 and close 2, 3, 4 times above it, then that's probably a market signal that the carryout is starting to contract and that we may be able to push a little bit higher. But we've got a lot of work to do to get there, and the first test is right in this 850, 855 range to get up out of there. All right, let's look at corn. I'm going to skip straight to December because we got 10 minutes left and a lot to cover. All right, we've been talking a lot about December corn and what is the plan. I kind of want to put it in perspective, okay? So if you count from the move earlier this year, which would be kind of right in the beginning of January, and you count to this low here, a 38.2% retracement prices in at 363, and a 61.8 prices in at 386. If you don't know what those numbers are, those are Fibonacci retracement levels. I'm not going to get into that. Fibonacci retracement levels are something that traders all over the world look at. and there's a lot of study around them, but they tend to be fairly reliable. Now, what I want to show you is the commitment of traders, because as you look at the fundamentals, what in the world would cause corn to go up, right? We've got a 3.5 billion bushel corn carryout. It's planted, it's emerged, the weather looks pretty good. There's a lot of talk of yield being above 180, 183, 4, 5, and those are all very bearish things. And if demand gets hit worse, that's even more problematic. And you've got these fundamentals in the supply and demand tables where exports have to be 120% of last year. Ethanol's got to be 92% of last year. You've got to have feed usage at 110% of last year in order, and all of that has to be there just to get to a 3.3 billion bushel carryout. If any of those fall and yield hits, our carryout swells way beyond 3.3. So the bearish case for corn is very legitimate, and something that cannot be ignored. So the funds have built this short position. This is the commitment of traders chart. And what we're looking at is the blue line. This represents the large spec or the managed money crowd. These are the aggressive traders, right? They're the ones that can push the market one direction or the other. So as you look at this chart, you can see that they really started to accelerate a bearish position on about this bar right here, which is the week ending April 7, okay? So if we look at April 7 and we look forward, this is 50,000 contracts. As of last week, they were at 250, just shy of it. So they've sold in the last 1, 2, 3, 4, 5, 6, 7, 8 weeks, they've sold over 200,000 corn contracts. So what does that mean? This is the April 7 mark right here, okay? They've sold 200,000 corn contracts as of last Friday. And they've only got 100 or 20 cents of upside in gain in that situation. So they've had very little reward for the risk that they've taken, and they've sold 200,000 contracts. So what is a catalyst that could propel us up into this 38.2% retracement level? Well, honestly, that fund position is probably your best catalyst. And what would spook them? If we can break up above this level of this trading range in this 335 to 340 level, and really if we can kind of muster some support all the way back up to this 345, 350 level, what that does is bury the shorts. Anybody that sold past this date would then be underwater on their short position. So a close above 350, 355 for 2, 3, 4 days will start to make them very, very nervous, especially if we end up with a little bit of a bullish forecast. So if that heat forecast starts to expand and carry out into 14, 20, 28 days, then now you're talking late June, and now you're talking into the time period when that heat really starts to matter, especially if the nighttime temperatures start to increase in that corn belt. So if we can bury the shorts below above 350 and they have to cover, then that's your fuel that can push you up into these fib retracement levels right up into here. And if we get up into this area, then this is a sell zone. I've got it highlighted. And I've got it highlighted from May 28th through July 14th. The significance of those dates really needs to be paid attention to, because when you look at the seasonality of these charts, let me pull up a seasonal chart of corn here, okay? So if we look at the seasonality of corn, this is a 30, 15, and 5-year seasonal chart of corn, and this is May, about May 10th, May 11th. This is July 1, this vertical dotted line. You can see that in the last 30 years, there's been very little upside potential past July 1 in the corn market. And to be honest, that keeps creeping forward on the calendar just a little bit. So we're really this June 15, 16 level. So on our chart, we've got that time period highlighted, where if we can pick up a rally and bury the shorts, and if we can get up into that 38.2%, then that needs to be a sell target. And if we rally through it and the weather changes and we're now talking about $4 plus corn, great. Nothing would make me happier than have to re-own $4 corn in this market, because that would signal something radical has changed. So from a corn perspective, right, your crop insurance level is right here at 390. Most of you have roughly 160 bushels an acre insured at 390. So that leaves 50 to 75 bushels an acre uninsured and unpriced if you haven't taken any method. This would be a great target to sell at least those unpriced bushels if we can get up into there. And it's why I love the accumulators coming out of Indigo, because today the market's at 330 and we can price you at this 360 level right now. So you can start pricing, you know, if you do 10,000 bushels, you're basically pricing 70, 75 bushels a day at 360 every day that the price of corn trades above 320. So you've got a nice risk reward. You can price up here every day the price stays above this 320 level. So, and if we break below it, we can attach a put. And if we break to the downside, then we can at least cover ourselves and have our downside risk removed. So it's okay to hope for a rally through mid-June. If we don't get it, we may just have to take a sale we don't like, because the downside risk is very real if we get into a carry out that's above 3.3, 3.4. So those of you that have been talking to me regularly, that's why we like those accumulators, because they're helping us price up in this level. If we do get a rally up into here, we're going to be selling it. And if we don't, then we're going to be putting more hedges on below 320 in December, because the downside risk is real and we can't really ignore it. All right, I hope that is somewhat helpful. It's a lot to digest, but remember, 200,000 corn contracts sold for little to no reward. So just a small rally buries them, and that's the fuel that can propel this market higher. Markets don't have to have a reason to do anything. They can just move because buyers overwhelm sellers and vice versa. So fundamental headlines wouldn't have anything to do with this unless something changed. So I hope you guys have had a great week, and I hope you have a great week moving forward. If you have questions, please call me, and we'll continue to look at things and keep you up to date if anything changes. Have a great week.